My name's Paul Durward. I'm from Atlas Fund Services. Atlas Fund Services, in a second I'll introduce you to the panel. Atlas Fund Services was formed in 2006 as a sister company to Citco Fund Services. And basically we oversee around 180 different funds in the alternative fund industry, ranging from around 60% standard hedge funds vehicles, your global macro, fixed income, long-short equity type strategies. And the other 40% I would say is private equity, real estate, venture capital, private credit funds, etc. We have two offices, one in Charlotte, North Carolina. My colleague April Spencer heads that up. And I'm based down in the Curacao office where we oversee a lot of our offshore business. So I'll take the opportunity to introduce you to the panel, very experienced panel, I'm happy to say. First of all, we have Angela Cole from Stonefly, we have Jeff Haas, Old Hill Partners, and Alberto Cibles, is that right? Good. I'll let Angela start with a brief introduction of herself and we'll move through the panel there. Thank you.
Well, good morning or good afternoon, I guess now. So I'm Angela Cole. I lead the Stonefly Investments, which is a private equity fund. Our space is investing in energy companies. One of our largest investments is in an E&P company that does drilling and production in conventional wells. So we know the energy space pretty well. Our management, along with our operating team, has decades of history in the energy sector, and we have produced billions of dollars of value in that space. My background is I am a recovering banker. Prior to joining Stonefly, I was with JP Morgan Chase for 15 years in the corporate side. Also have done public debt and syndicated deals as well. And I live in Louisiana, which I will say that it's really not hot here.
I thought you said it was going to be quick. That's quick. Hi, I'm Jeff Haas. I'm the Chief Operating Officer for Old Hill Partners, and we focus in a segment of private credit, specifically in the asset-based lending space. Generally, our focus is looking at senior secured opportunities, which would be defined as more small balance lending. So we focus on transactions that tend to be sub $25 million. The maturity profile on most of what we do goes out between 1 and 4 years, and the coupons will be somewhere between 8 and 15%. It is very much an asset-based focus, looking at both financial assets and hard asset opportunities. One of the things we don't lend against, we know it's part of this panel here, but we don't lend against real estate. So, but other than that, we'll look at a variety of different opportunities in financial and hard assets. My background is, again, I've been involved in this space for over 20 years, and we think it's an interesting opportunity for investors looking for yield in a world where yield is hard to come by. With that, I'm going to turn it over to Alberto. Now, he's got a slideshow. I didn't bring one, but we're going to be entertained, I think.
Hi, good afternoon, everybody, and thanks, Flya, for this invitation, especially Mike Corselli, which I met probably like 2006 when he had this idea of creating Flya, which, congratulations to Mike on his success. So I'm a founding member of Glide Capital, and also founding member of a company called Scala Capital. Scala is a multifamily office, and Glide came out it's a spin-off of the multifamily office, and basically, let me see if the slides are coming in, I can show you. But my background, I've been 26 years plus in the financial industry. I'm a fixed income trader, always looking for fixed income opportunities. And what's interesting is around 2012, 2013, yields went negative across Europe, and it was very hard to find fixed income products. So we started investing in alternative credit, and we came with an idea that there was all these new funds out there, especially using fintech and loan origination through technology, and we thought that it was an interesting idea to offer a platform for wealth managers that didn't have the time or the expertise on doing due diligence on these funds. Actually, that's how I met Jeff. It's one of the funds that we have approved in the platform. So basically, and here's part of the slides. I guess, is he going to switch or? Yeah. Are you moving or should I move? Yeah, thanks. Thanks. All right, so basically, all right. Okay, so we created a platform that does, we find niche strategies, we do the research, we do the traveling, we do all the work that, normally, an independent advisor would do. We also, we do a custom-built solution for this advisor. So one of the unique ideas on doing this is, since from our background, we used to do a lot of alternative investments, sometimes you have all these, great funds that you find, but maybe it's not in the custodian or it's not transparent. So the idea that we did in Glide was to create this unique solution where you can find, you can create a custom-built fund of private credit and have it for investors in any custodian worldwide. So we're approved in more than 30 custodians. We've been in business for close to 4 years. We've done research on probably around 450 funds in this space, mainly in the U.S., and we've approved 22 funds in the platform. So this is kind of what I just mentioned. 448 managers that we've screened. We do comprehensive due diligence. Then we go through a committee, and then we approve the funds that are available. Right now, we have 25 funds, which 22 are open. And this is what Glide. Right now, we're 350 million in assets under management. We have 22 funds approved and 26 portfolios from the clients that have done it. And we do offshore and onshore as well.
Okay, great. Thanks, Alberto. So the topic today that we're going to address is private credit funds and their performance issues in a recession. Atlas Fund Services, I mentioned earlier, we have a number of private equity vehicles, private credit funds on our platform, and I'm certainly interested to hear from the experts here as to how they maybe see the industry progressing in the case of a recession potentially. And I'd like to open up to Angela, who's obviously, she's got some expertise in the energy arena.
Yes. So just giving our experience and depth in the energy space, we believe that oil prices truly are going to be less receptive to a soft recession. If you look at the 2008 recession, oil prices, while they dropped, consumption had dropped 2 million barrels, and this is gasoline consumption, in a period of 2 years, which is a very small drop. We also feel that there is an emerging story with oil and gas production here in the United States. The United States currently is producing and exporting over 9 million barrels of oil. And of that amount, that has been truly the highest that we have seen so far, and we anticipate that to grow. And this number is not being impacted by the reduction in the consumption or what we're selling to China. So while China has cut some of our buying, we have still continued to see an increase in the amount of oil and gas that we've been exporting. The data is also showing that international markets are robust. India, in particularly, is a space that has continued to buy from the U.S., so much so that even the cut that we have seen from China has been eclipsed by the demand from India. Here in the United States, households, power plants, and factories are very robust in the purchase of natural gas, usage of natural gas. So ultimately, while you might see a drop in oil prices, if we have a deep or an extensive recession, you have also seen that with the last, not only recession, but the last oil prices drop in 2016, there has been factors that both producers and operators have adjusted to. Another example is OPEC. OPEC has been open and has continued to adjust their production as oil prices have declined, and we don't anticipate that to change. Traders are confident that producers will continue to adjust to the weakness versus watching oil prices truly collapse. And also, companies today are positioned much better than they've ever been. Both producers and drillers have learned a lot from this last oil price collapse. They have really have a sense of having put some cost cutting. There is efficiencies in the production side, and we feel that unless you really see a real deep recession, oil prices will remain fairly consistent.
Thank you, Angela. Jeff, your perspective.
Yeah, I think it's worthwhile to kind of set the stage a little bit in terms of talking about just private credit in general and how it can react in recessionary periods of time. And I think one of the things that we need to talk about right up front is really the approaches to lending. There are two really major approaches to lending. One is more of a cash flow, EBITDA-based approach to lending. People often refer to that as more direct lending. And if you look at the marketplace in private credit right now, it's been hot. There's been a lot of capital raised, and I think where a lot of that capital has been raised is in what's been defined more as the direct lending side of the equation. Again, much more cash flow oriented. The flip side of that type of an approach is an asset-based approach. And there you're looking at obviously the value of the asset and lending in some discount to the asset value. We'll refer to that in my business as the loan to value or LTV. Both of them are very different approaches, and both of them have very different risk dynamics. In recessionary periods of time, I think what ends up happening is on the cash flow side of the equation, the companies that generally lend on a cash flow multiple basis are going to be much more sensitive to the economic contractions that may occur in the marketplace. And I think we saw that during past recessionary periods of time. On the asset-based lending, it's not immune to price declines in certain assets, but the severity of those declines is much more muted. And in general, what you found is in asset-based lending that the recovery rates in asset-based lending tend to be much better than in the cash flow side of the equation. So, as people look at are we moving into a recessionary period of time or not, I think they need to be focused on the type of lending that they're investing in or are already invested in, and looking at the sensitivity to the economic contractions that can occur with that. It's funny, we did a white paper back in 2016 when the topic of a recession was a big topic also. And what we did is we looked at the past 4 recessionary periods of time, and we looked at asset price declines that were occurring during that period of time. And what we found is that, consistent with what I was saying, is that the Russell 2000, which could be more of a proxy for the cash flow of small companies and the cash flow associated with them, had the biggest decline in terms of asset prices. Unfortunately, commodities was another one that had a pretty significant decline. But as you move down the scale, price sensitivity and declines during recessionary periods of time for other assets, machinery, equipment, inventory items, stuff like that, the declines are much, much more kind of minimal. And then I would add to it the importance of investing in the type of structure when you try to invest in this activity is very important. I think one of the major differences today than during the financial crisis, coming into the financial crisis, is that most private credit or illiquid asset opportunities in this space were structured what I would call as inappropriate. There was an inappropriate asset liability. Most funds were structured as a one-year locked-up vehicle with some type of quarterly and monthly liquidity. I think the market's learned a lot from that, and that when you look at a lot of funds today, and maybe Alberto will touch on this, you'll see fund structures that are much, much different than that. They tend to be a little bit more of what I would consider more of a more private equity-like structure, where managers are attempting to match assets and liabilities. And that becomes very, very important in these recessionary periods of time, because you don't have managers potentially rushing into the market with the illiquid assets, trying to redeem them to redeem investors because of the structure of the fund. So, I mean, I think that people, especially in our particular asset class, asset-based lending, if you're looking at that in private credit, people are really kind of characterizing this as a little bit more of a defensive play as we potentially may head into a recession. We did a white paper. We have them available if anyone wants. And just coming into the year, we talked about the likelihood of a recession this year, and I think our predictions are going to kind of play out. But that doesn't mean that it can't happen in 20 and 21. And what do you do in the event that that does happening, and you want to invest in this kind of space?
Yeah. So yeah, I agree a lot with Jeff, and the most important thing here is, who knows when the recession is going to happen, right? It's very difficult, and a lot of the recessions, the stories has told you that, we're already in a recession, and then the people said, oh, now we're in a recession, right? So for us in private credit, what we want to do and what we want to tell investors is that we want to, we learned from '08, so what are the things that you want to avoid on private credit if we have a recession, right? So first is, like you mentioned, leverage funds. So if you're using leverage on private credit, and we have a slowdown, I mean, definitely your fund is going to have problems with performance and also with liquidity. You're going to be stuck, and probably the banks are going to be very aggressive on the liquidity side. So mainly, most of the funds that we approve in the platform, they don't use leverage. So that's one thing. The other thing is, if you see on the slide, right now, depends on who you follow, but there's a study right now, we're around $700 billion, and that's the size of the private credit industry. Some people are saying 800, maybe next year we'll be in $1 trillion. But if you see the different circles, there's a lot of money in consumer. So in consumer, you have loans from 6 months to 5 years where there's no collateral. It's basically on FICO and credit scores. So, in '08, '09, if you look at default rates on consumer loans, specifically credit cards, you're going to have a big spike on defaults. So that's an area that we're avoiding, and that's where a lot of money have gone to. So that I would say, whoever wants to invest in private credit, that's an area that you have to be really careful. And in the other side, which Jeff mentioned, the industry, you have the direct lenders. So basically, direct lenders, it's more based on cash flow, and some of the funds that we've looked at there, we really want to know, okay, if we get a recession or if something happens on the loan, how do these funds take over the asset? Are they experts in the area? Do they know how to turn around a loan and fast, so you don't have to put liquidity clauses on the fund? So in our approval rate, we really think that right now you have to have a lot of collateral on the loans that you're doing, and you have to maintain a short-term orientation, because we don't know if recession will hit now or in 2 or 3 years. But if it hits, you're protected from short-term oriented. Does it have some loans you can get daily or weekly cash flow inside the funds. And then on the LTV, like you mentioned, on loan to value, on asset base, we really like real estate as a strategy. So we have a lot of funds. I would say probably half of the funds that we have proven in the platforms are commercial real estate, where we have loan to values probably around 55%. So if the loan doesn't get paid, you're gonna buy the property with 30, 40, 50% discount on the market, and you can, if the fund manager is an expert in real estate, he can quickly turn around, and actually the fund would even make more money. The only thing in private credit, and people don't talk about it, it's the things on liquidity. Like Jeff said, there's a lot of funds, especially in direct lending, where they give you monthly and quarterly liquidity. But if we get a recession or we get a slowdown, it's going to be an illiquid fund. So people have to understand that, when you're going to invest in private credit, if the loans are, 2 to 3 years, you should expect that the investment is 2 to 3 years, and not what the fund is telling you. It's a quarterly liquidity, because when things go wrong, you're going to have that illiquidity gone. So I would say, nobody knows if we're going to get a recession or not. The only thing is, stay nimble, find niche strategies, and there's some strategies that we have found that are not even correlated to the markets, like life insurance settlement loans. Rates can go higher. There's going to be a recession, but there, at the end, you're gonna get the loan back when the cycle happens. So that's the message I would give to everybody here in the.
Thanks, Alberto. I'm interested in exploring the sort of word, the elephant in the room that gets thrown around a bit, bubble. And some people suggest that the equity market right now is potentially facing a bubble scenario. People might even argue that with the private credit in a recessionary situation, that might be exposed to bubble-style economics as well, and that banks would obviously stop giving liquidity. How do these funds sort of, you've talked about collateral, but maybe we can expand on the other areas that these funds can protect themselves from a bubble-style situation, or banks ceasing up with their liquidity.
Yeah. So here what happens if this scenario happens, right? How can you protect yourself on that? So the first thing, and that's why we think it's interesting, that when you invest either in a fund or in a structure that has the capability of investing in different funds, that you have a lot of diversification. We even talk in our presentation, we talk about atomization of the risk. So maybe you have 12 funds, and each fund has 50 or 100 or 1,000 loans. So at the end, the default rate or the problem is going to be just the statistics on the numbers. So that's one thing. The other thing is, as we mentioned, if we're going to have a collateral, is that collateral, is it liquid? And does the fund manager has the expertise on bringing that liquidity? So some of the funds that we've seen out there, we've seen great marketing and great presentations, but when you look at, somebody is offering you a fund, and even the fund can be $1 billion in assets, and it has a great track record, do they really know how to turn around? And are they in states, like somebody mentioned, I think in the panel before, are you in a state that, you're going to have to go through litigation to get the asset, or is it an easy state to convert the asset into a liquid asset? So that's where we focus a lot on the due diligence that we do, and we want to have those funds that are very experts. And some of the managers that we have approved, they went through already, 01, 02, and 07, 08, 2008. So they have a proven record on how to do it, right?
I would just add to that there's a couple things. A couple of them I've already talked about in terms of trying to protect yourself. It's really the structure of the fund that you're investing in, and kind of the approach. We talked about both of those. In terms of one of the things that we do on our asset-based lending is most of the time what we'll be doing is we set up a bankruptcy remote special purpose vehicle. The asset itself is placed into that vehicle, and our loan is senior secured at that point. That's very important, because there are definitely other asset-based lenders out there that'll do asset-based lending, and it'll be just a general blanket lien on the corporate balance sheet. Having that asset and the control of that asset in the event of a default is really important because it allows you to move quickly on the asset and take it into your possession, and then potentially dispose of it, cash flow it, or whatever. Since 2009, we have done about close to 50 or so transactions and placed over $400 million in these private credit opportunities. We have had 3 transactions go what I call sideways. They haven't been payment defaults, but we had to actually move on the collateral, seize the collateral, dispose of the collateral, and in all of the instances, we were able to get our money back and a return on the capital. So, that's just one approach in terms of kind of how I think you protect yourselves in the event that there's a problem. And the other thing is, when you're underwriting these deals, and we do it, you'll see it in all of our investment committee memorandums, what we're really trying to do is stress test the assets because the 07, 08 financial crisis is so still fresh in the minds. We stress test our assets in that vein in terms of looking at it, how would they have performed in that and in those scenarios, making sure that we have sufficient cushion in the LTV, and that cushion we usually get is from the borrower themselves, which is usually the skin in the game or the capital at risk that they put into the transaction, which is really an important element of almost every transaction that we do. We want to make sure that we're properly aligned with the borrower. So alignment and structure are 2 things I think you can really try to pay attention to.
Your perspective?
Yeah, so, I feel that truly the energy space today is in a different place than it was even in 2016, and that's primarily due to 2 things. Technology. Technology has been significant in this industry, whereby even today, when you see the geopolitical instability that is happening, you haven't seen a huge delta change in oil prices. In 10, 15 years ago, an event like what's happening in Venezuela, or even the attacks that you've seen in the tankers in the Middle East, would have caused a huge spike in oil prices. There was a spike, but we saw a very quick drop and instability in oil prices. Technology is key to this because it has allowed the U.S. to become such a large producer of oil and gas, whereby we are becoming more independent and importing a lot less oil and gas. So from a recession perspective, again, the financial crisis happened in 2007, 2008. Oil prices were not impacted. Oil prices were impacted in 2016. But from a going forward perspective, data and occurrences are showing us that really the energy sector just is a little more immune to a soft landing or a soft recession.
Thanks, Angela. One area that came to mind when we were watching the prior panel was the question of tokenization and things like that. And I was curious, I'm bringing this out of the blue to them, I'm curious if they have any perspective on that as far as how it pertains to their industry, from a liquidity standpoint. From what I'm seeing right now, banks seem to be getting tackled from a number of sides. And if we look at what's happening with the Facebook announcement of Libra and just generally cryptocurrency since 2008, you could argue that banks are starting to feel a little bit of pressure as far as where their fees going to go potentially if we end up having a global market of cryptocurrency, as Libra is sort of looking at right now from Facebook. I wondered if any of your firms had started looking at potentially tokenization, or perhaps not.
I mean, as a firm, we haven't looked at it, but I mean, from afar, the practicality of it is in having a potential investment strategy that focuses on illiquid assets. Really, anything that kind of brings liquidity to those illiquid assets, I think, has a benefit that eventually, I don't think it's there yet, but down the road, could it be something that could be used as as a liquidity mechanism for investors in these types of funds, yeah, I think you could probably see it.
Yeah, we haven't seen it yet in this space, but I mean, I think it's going to go there. Kind of, I mean, the idea of us creating a platform and offering, smaller amounts of money to investors and creating QSIPs and ISINs on custodians, it's a little bit of, doing tokenization of this industry, but it's not what they do in blockchain or all that. But, I mean, it would be great that happens.
Yeah, I mean, maybe not necessarily in tokenization, but in private equity, obviously, that's where a lot of capital has been moving towards. Our platform and our strategy is to invest in energy companies that are currently doing conventional drilling, which means that our break-even cost to produce a barrel of oil is less than $30. We produce what you call Louisiana Light Sweet Crude that sells in the low 60s. So from a liquidity perspective, we have a lot of delta there to play within our fund, yeah.
Great. I think unless anyone else has anything in particular they want to address, I think we've got time to open up for some questions. Oh, sorry. Actually, just before we do that, we've got one more slide from Alberto.
No,
Yep.
maybe on the questions.
Okay. We could put the slide up in the meantime. The final slide, please. There we go. You want to address that?
Yeah, well, a lot of people think of private credit, either, it's a fixed income solution or alternative, or some people see it as more as a alternative or a hedge fund. So my idea here is that, this is right now where you find interest rates across the U.S., where you have cash equivalents are probably around 1-2%. Treasury is the same. Investment grade probably like 3-4%, and then high yield is probably around 5-6%. So, the world that we live in is all that is, senior debt could be levered or unlevered, subordinated debt, distressed credit, specialty finance. So we wanna maintain that, as long as you are diversified and as long as you're finding niche strategies, your returns are gonna be somewhere between, I don't know, it could be 7 to 14%, and there's always gonna be a spread of maybe 4 to 6 points on the high yield market. So this is something that you guys can see where the market is right now on private credit.
I would just add to that, we do look at the same kind of thing, and really when people do look at those returns, at first some people that may not look at the space may be a little bit surprised in terms of looking at those types of returns and want to initially kind of shift you out in the risk spectrum. I think an important thing to kind of note here, and Alberto touched on it a little bit, is that those returns that you're getting in this space, there is a significant liquidity premium that different strategies bring to the market. He referenced the high yield market. I mean, we think the liquidity premium on what we do, depending on the transaction, is anywhere between 400 and 700 basis points. So if you can stand the liquidity of it, it's a good place to invest for people that are looking for yield.
Any closing comments, Angela? Are we good? Okay, great. Thanks.